Thanks for joining us for another episode of The Money Puzzle. I'm Eric Douglas. This is Aaron McAndrew, a production of Family Wealth Planning Partners. Pleasure to have you here with us again today. Topic for today, we're going to talk about trading versus investing. I talk about this a lot actually. But I heard another quote today. I've used this quote a lot, and I figured this would make a really good podcast. And especially when we get in times of market volatility like we're experiencing now, this starts to come to the forefront again. Like, making moves to avoid market drops or taking advantage of gains and things like that. And what are we doing, right? We some clients anyway, most clients don't even care.
Right. Yeah.
But we always have certain clients that want to know kind of what are we doing in response, what are our thoughts on the market, and so on and so forth. And I certainly have a lot of thoughts on the market on any given day. I'm probably the biggest investment nerd, if you will, on our team. I love talking shop. I love talking investments. I geek out on stocks. I love that stuff. But it's funny because at the end of the day, a lot of that stuff doesn't really matter on a day-to-day basis. But we'll get more into that. But the quote I heard that I wanted to kind of build a podcast topic around was, when you are trading, you always have to be right twice. You have to be right when you sell, and you have to be right when you buy. And if you get one of those two things wrong on any given trade, you're wrong. You have to consistently get the buy, and you have to consistently get the sell correct. And then you have to repeat that process over and over and over again.
And that's extremely difficult to do.
It's insanely difficult,
if not impossible.
And it's amazing too, because the traders that do that very, very successfully are the traders that stare at their computer screens all day long and do nothing but consume and watch the markets. And that's all that they do for a living. And usually the margins that they achieve by actively trading their portfolios or trading their strategies for other people, usually the results are negligibly better.
Right.
Maybe. More often than not, they're not any better at all.
Right.
And we've seen this. I've been in the industry since 2007. You're about the same for yourself. Yeah. So we've both been around for almost 2 decades now. We've both been around the block long enough to know that is absolutely the case. You might have some years where you might be a trading superstar and you hit it big. Then the following year,
but you don't hear about those.
You don't hear about the bad years. You always hear about the really, really good years, right? That's the idea, right? Trading is insanely hard to maintain, especially when we're talking about trading in the stock market, because the stock market, by definition, is volatile and very, very unpredictable. It's so interesting because we watch probably economic data dumps, if you will, more often than most people. We typically have, Fox Business or CNBC on at our office and keep it on in the background, and we're seeing some of the economic news come out, and we'll see, maybe an inflation report or some jobs data that comes out that on the surface you think is positive. Oh, that's actually pretty good economic news. Then you see the market start to collapse after that economic data comes out. It's like, why is the market reacting the way that it does? And vice versa. We see some bad economic data come out and we'll see the market pop. But that's just what happens. It's very, very unpredictable.
And we also just want to know, it's not that we're getting our information from those shows. We also want to know the message that our clients are hearing from those talking heads
more than anything,
on the media. Because most of the time there's a hidden agenda there with, what they want you to believe or what they're saying is going to happen at this point in time. No, it's real information that comes out. But a lot of time there's a different agenda.
Yeah, and so it's just very, very interesting what you're hearing in the news media, because the news media that most people consume on a day-to-day basis is entirely infatuated with trading. Jim Cramer, right? He's the crazy guy that you see on CNBC who's always telling you to buy or hold, and he's hitting the red button. Yeah. He's talking about individual stocks, and he's giving his opinion on individual stocks. And it's interesting because he's probably the most popular personality in our industry, or certainly one of them anyway. There are entire blogs devoted to how wrong he is all the time, okay? But people follow him and get their ideas from him. And if you're creating a portfolio based around a lot of the recommendations that he's making, you're not always doing very well.
Right.
And he's also only giving his opinion on one side of the trade. He might tell you when the buy trade is supposed to happen, but are you tuning in every single day to hear him say specifically when to sell that specific holding? He may not ever come back to that holding and give a sell signal. It's just based upon whatever's happening in the markets that day or whatever's happening in the media that day. And so it's really, really hard to, once again, always be right twice. It's not being right once. You can miss the downside. You can also miss the upside if you don't realize 2020 is a perfect example.
Yep.
I saw this a lot in 2020. And I'll even use ourselves as an example because looking back, it was actually relatively easy to predict. And we made some good moves in 2020. But when the government comes out and says, we're going to shut everything down, stay at home, okay, it was pretty easy to tell that we needed to sell some stuff and move some of our positions to cash because we're going to have a market crash. That was pretty easy to call. What was not so easy to call was the result of the stimulus packages that were passed in 2020 as a result of the COVID shutdowns and the effect that would have on the market. Nobody would have predicted on March 23rd, I believe, was when we hit the bottom of 2020 when the market was down something like 30%, maybe a little 35%, yeah, whatever that number was.
From the highs, yeah.
And that had happened in just over a month. It was like February 16th or something.
Correct.
So from February 16th to March 23rd, when we had the absolute market collapse, no one would have predicted at the end of March the type of run that we were going to have through the end of 2020. Nobody called it.
And even
Nobody
through
saw
2021.
It certainly extended into 2021 for a lot of sectors, absolutely. But no one could have called that because, once again, market predictability being what it is, no one knew.
Right. And I'm going to share a little bit of a story here. I work with a lot of retirement plans. That exact same time period, when we go from all-time highs on like February the 16th or 15th, whatever that day was.
And the market was at all-time highs at that point.
All-time highs to lows. It's a record drop that it went down as fast as it went down, as much as it went down that quickly. It was a record free fall, essentially. Basically, the bottom fell right out of it. I had participants in retirement plans that were ready to move to cash. They were scared. They had already lost the 20%, 30%, whatever their investments were in. It probably wasn't the full 35 because most people aren't just 100% in the stock market in those investments, but they were still down 20+% because of that record free fall. They said, so do I need to move to cash? Should I move to cash? And my question for them, and I do these account reviews regularly, a couple times a year I'm in there meeting with these participants. So I knew the answer to this question when I asked the guy over the phone, but I wanted him to say it. I asked him, I said, at what point in time how many years left do you think you have until retirement? And he said 15. And I said, okay, so do you think the market's going to recover in the next 15 years? Are you putting money into this retirement plan? And the answer was yes. To both. I think that's going to recover in the next 15 years, and I am putting money into this retirement plan. So if you're putting money in the retirement plan, why would you want to move it to cash if you think the market's going to recover before you're going to retire and you're continuing to put money into cash, essentially? You're not going to put it into the investment. So I had to explain to him how the market works, essentially. If you move all this to cash, it's in that fixed account like we talked about. You're not going to have volatility. You already realized a 20% loss, essentially. That's when you realize that loss. Okay, you're going to continue to put your money in and not buy at the low cost. It's going to go into that cash account. Going to get the 1% growth, but you're not going to get the volatility with it. So the stock market is one of the only markets in the world that people run away from when it's on sale. Mm-hmm. I use gas price. This has really helped in these review meetings. I use the cost of gas and I say, okay, what's the price of gas right now? And they say $3.80, $3.90 a gallon. And I said, okay, if I was driving home and I drove by that gas station down there and I have a half a tank of gas left in my car and I saw that gas for $1.99, would I pull in and top my tank off, or would I keep driving knowing that I got a half a tank and I tell you what, I'm not going to get the gas until I see it again, until I need it, in which I know I'm going to pay $3.80, $3.90 a gallon for? And they go, oh no, you pull in and top that off at $1.99. Yes, I would. But you're doing the same thing in a retirement plan. When you're putting money in and the stock market's down 20%, instead of putting more into it, they want to take the money out of it and let it park and not have the opportunity to grow because of exactly what we're talking about today. You can get out, but my first question to them is, at what point in time are you going to want to get back in? And most people's answer is, well, when I see it go back up, when it's gone back up.
Too late.
If you're out at that point, the first day it goes back up, the second day it goes back up, or the third day it goes back up may be the largest single day gains that you're going to get. So if you miss the first 8% rebound, what's it going to do? Probably bounce around a little bit, and then you're going to get sick to your stomach again because you're losing more money, and you're going to probably be there. That's how a lot of these people in 2008, when that started happening, moved to cash and never got back in and missed 8 years, 9 years, 10 years of growth.
I still talk to clients that made overly emotional decisions in 08, 09 when they just couldn't take it anymore.
Yep.
Just emotionally, they were at their wits' end and they could not take the destruction in the market anymore. And when the market was down at its lowest point, they made a decision to move to some type of product, and they lost out on all of the growth that happened for the next decade. When you go into a store, when you go to the mall, go to a clothes store, where do you typically go first?
I don't go into the mall very often, but
pick a store that you go into, Aaron. You're not helping my analogy here.
I'll go into one of the big box ones on the corners of the mall. To enter the mall first. That's the first store I'm in, then I'll go down,
Okay, well, typically most people, when they walk into a store, most normal people anyway, when they walk into a store, they typically go towards the back and find what? The clearance rack.
Yes, okay.
They find the clearance rack. Why do they go to the clearance rack? Because that's when the sales are the highest. You find the cheapest stuff to buy on the clearance rack. March of 2020, October of last year of 2022, stocks were on sale. Stocks were on the clearance rack. They weren't just on sale. They were at a supreme discount. Since October of 2022, and I had some serious conversations I lost one client actually, who just watched way too much. She consumed way too much news media, and she moved to gold. I did everything I could to talk her out of it, and she moved to gold. She probably doesn't even realize it because she only watches a certain type of media.
Right.
But she's missed out on the run-up in the market since October of 2022 up through now.
Yep.
And a lot of the losses she sustained, and her account wasn't even that bad by comparison to the market itself. But for her emotionally, she just kept seeing, the market decline to some degree, and emotionally she couldn't handle it, and she wanted to move to a safe haven, and she thought the safest of havens to move to was going to be gold. Mm-hmm. That's another discussion for another podcast. We're not going to get into that now because that's
another 30-minute conversation.
That's a whole ball of wax, and we're not going to get into that. All that to say, she perceived safety in gold, and she wanted to move there. She made an overly rash and overly emotional decision, and she was wrong on that trade.
It was probably driven by media.
I know for a fact that it was. She told me it was driven by media, and she told me that it was driven by her own fear, and she accepted that, and she knew that, and we had a long conversation about it. And I had a couple other tough conversations, and those clients made the right decision, and they didn't they did not act emotionally. They acted a little bit more rationally, but they were emotional when they were wanting to have the conversation with me originally, which is totally okay, and I totally understand that because money is emotional, right? Money determines your lifestyle. Money determines, for a lot of people, I don't want to say money determines your happiness, but it does determine your lifestyle, and your lifestyle is what brings you happiness. Right. So there is intrinsic value, obviously, to money. Money is not everything, but it's definitely something. When you're talking to clients about October of 2022 or March of 2020, stocks are on the clearance rack. That's the best time to buy.
Yep.
When others are being greedy, be fearful. When others are being fearful, you should be greedy. That's one of Warren Buffett's, the Oracle of Omaha, right? That's one of his favorite quotes, is be greedy when others are fearful. When you're seeing extreme fear in the market, that is the absolute best time to buy.
Yep.
When the market is at the lowest of the lows, when people can't stand it anymore, they call it capitulation. That's the point of market capitulation, where people just throw their hands up and they give up and they say, screw it, I'm done, I can't handle this anymore. That's the best time for you to be hitting that buy button. A lot of people just can't do it.
And even us, this just kind of shows again how difficult it is to time the market. To know when to get in or when to get out of the market is extremely hard to do. Even us. If I was to ask you in October of last year and said, Eric, do you think that we're at the bottom? Knowing the interest rate environment we're in, knowing that the Fed was not ready to put the release up on the gas pedal, knowing inflationary environment we're in, knowing what was going on over with the war, we're still not completely through supply chain issues, knowing what we've got happening with
Residential real estate, commercial real estate.
Exactly. All these things going on. If I was to ask you, Eric, last October, do you think we're at the bottom here, or do you think we're going to retest the lows?
I could have easily said, no, we're not at the bottom.
Exactly.
And if I'm sitting here when the market's recovered significantly since October of 2020, I can sit here with a straight face and tell you we still might not have hit the bottom.
Right.
I hope not.
Right. I agree.
And I can give you an argument for why we haven't hit the bottom and why we might have another, let's call it crash or another correction. I can also tell you why we won't have one. There's good economic data out there. There's bad economic data out there. You talked about the supply chain. Supply chain issues are not great, but they're a lot better than they were.
Way better than what they were, yes.
We don't have the barges sitting out off of LA County in the Pacific Ocean that can't come into shore. We don't have those anymore. We don't have those logistical issues that we had during COVID. The economy is open. If you've been to an airport lately, it's still insane to me how busy airports are, how many people are still flying places.
Especially with the cost.
With the cost of flying being through the roof right now, people are still flying, people are still traveling. That's a sign of a healthy economy. There are always good economic indicators and there are always bad economic indicators. At any given time, I can tell you why the market's about to crash and why it's about to explode. I can give you a bull case, I can give you a bear case, any day of the week. It's just a matter of me also intrinsically understanding that these are my thoughts. I can give you a best case, worst case. I don't know what's going to happen. I have no clue. And anybody who can sit here with a straight face, any advisor in our position that can sit here and tell you with a straight face, this is what the market's going to do, that's not true. They're full of it.
Right. All this being said, and we brought up a whole bunch of different pain points and a whole bunch of conversations essentially that we really have and have had on a daily basis for the last 18 months or so.
And I love to have them. Yeah.
Right. All this being said, what is the way that because we don't just go in and go, oh, we're going to make a trade today, sell out here. Oh, we're going to time it. We want to make the most gain here and buy now or sell out now or whatnot. We don't do that. So the best way, and I wish we could show this on the screen here right now, is one of those color charts that show all the different asset classes. And it shows all the years it goes back 10 years or something. And it'll show, okay, large cap growth, large cap value, emerging markets, United States treasuries, all that there. And it shows them and it ranks them in order based off of where they were the highest performing. And very rarely is the same asset class up there 2 or 3 years in a row. Definitely not 10 years in a row. It may be down 2 or 3 notches. It may be at the very bottom, and then the one that was at the very bottom's up at the very top the next year. That chart is powerful in showing what a diversified portfolio will do for somebody that's investing for the long term. Instead of timing the market, making sure that portfolio is diversified is really the best thing to do.
We do make trades. We do make strategical changes in our portfolios. Absolutely. We just made one last week. But we don't make those every week. We don't make those every day. We review our portfolios at least monthly. Now, if we don't make a change, that's usually an active decision not to make a change, because we are nothing if not rational, overly rational, when we evaluate our portfolios. This is the benefit of being an independent advisor, right? We're not tied to, or we don't have to use any specific type of fund family or product, right? We can use anything that's out there. So if someone has the best bond fund, we can use that one. If somebody else has the best dividend fund, we can use that, right? So we can mix and match when we build our portfolios. We make strategic changes, but we're not overly emotional or panicking when we see any type of a correction in the stock market and thinking everything in our portfolio needs to be changed at the drop of a dime, because that overly emotional decision making over the long term in most scenarios is going to lead to ruin.
I like to relate, and I heard this, it's not my own, I wish I could take credit for this saying, but years ago somebody told me, making decisions, emotional decisions with your money, about your money, your retirement money, or the money you have during down market times is very similar to making decisions with your money when you've been drinking too much. Or I wouldn't recommend either.
First of all, I've made wonderful decisions when I've been drinking all my life. I've never made bad decisions there. But But yeah, no, that's a funny analogy. I've not heard you say that, but yeah, absolutely, that's true. You just don't want to be overly emotional when you're making those decisions, and you can't be. And really, when you think about the true value that we provide, a lot of people think, especially DIY investors that are trying to make active decisions, and they think that watching the media is going to keep them informed on what they should be doing. And in most cases, that's really just not the case. A lot of what we do is keeping people from making mistakes. And it's hard to quantify that sometimes because we're keeping you from making a mistake. And ultimately, if you didn't make the mistake in the first place, then you didn't have the loss. So it's hard to quantify specifically in numbers. And we're a very number-driven industry, right? But we're almost behavioral psychologists in that
Very
manner.
Much so.
We're there to help people make the most rational decisions, or at least explain to them the consequences of the decisions that they might make. Now, we can't stop someone from making a decision about their own money one way or the other, but we at least can help them be informed and maybe talk them off of the ledge a little bit. But ultimately, that's why we do planning. And so many times during 2022, what we were able to do, what I was able to do, was tie everything back to, okay, well, yeah, we've not had the best year in the market. Well, let's look at your plan. Okay, well, first of all, 19, 20, and 2021, those were the three best consecutive markets in history, right? It's really tough to expect consecutive 20% growth rates every single year. That's just not feasible, right? And historically speaking, out of every 4 years in the market, you get 3 good ones and you get 1 bad one. Well, we just had the 3 best years ever, and we were due for a bad one. At the end of the day, we were due for a bad one. Regardless of everything happening with inflation and economic decisions and the data and COVID and all that stuff, right? We were due for a bad one. We got a really bad one. That's okay. But whenever we're working with clients, we were able to bring them in and show them, okay, well, let's pull up your plan. Yeah, we've had a bad market, but let's look at what we've done with your portfolio, how we've structured it. This all ties back to our risk-off retirement strategy, right? And how did we bucket out your plan and show them, okay, well, is your long-term plan affected? What's that probability of success that you see on the screen right there? Oh, well, it's the same.
That's reassuring.
That's reassuring, but that's why we do it. That's why we do it, because we ultimately want to be able to point back to the data and the reasons that we made decisions that we did and the way that we segmented your overall portfolios to show you in down markets like we had in 2022, this is why we do it. Those are the markets, those are the reasons why we do things the way that we do, because we're ultimately able to preserve your lifestyles in good and in bad. And in those bad years, it's far more important that we're able to show them very clearly, very, very concisely, and also very rationally, you're still doing okay. You're on the right track. Nothing has changed for your specific retirement plan. You're good. Go home, enjoy your life. Stop paying attention to the market.
And in my opinion, that's one of the biggest values in using a financial planner. That's one of the biggest values. And I honestly think, in my opinion, the hardest thing about our jobs are that behavior, managing that behavior, the emotional side of it. Sometimes you'll feel like you're a counselor at some point, times talking people, like you said, talking people off the ledges or showing them. But when you refer back to that plan, that's powerful. When you can literally say, okay, your accounts may be down 20% or 15% or whatnot on your growth buckets. They may be down that much right now, okay? Look what kind of success your plan still is looking at having. What kind of effect has it had on your plan? And when it's not much effect, if any effect on their plan, they can breathe easy again. But that's one of the hardest things about the job. It's not necessarily picking the investments or deciding, designing the plan or designing the income plan. It's managing when people from making emotional decisions with their money.
Absolutely. And that's how we build diversified portfolios. We're not specifically talking about diversifying between stocks and bonds. We're diversifying risk in your portfolio. And that's the consensus, that's the foundation of our risk-off retirement income strategy. So with that being said, I think that's a pretty good place to shut it down for today. If you would like to schedule your own personal risk-off retirement strategy session, click the link in the podcast notes or go to our YouTube channel if that's where you're watching this, and you can click the link from there as well. Schedule a meeting with myself, with Aaron, with a member of our team. We would love to have you into our office. We would love to see you on Zoom if that's the easiest way to reach you if you're not in the state of Kentucky. Let's get together. Let's start to craft your personal risk-off retirement strategy session. If anything that we said today you feel could benefit any of your friends and family, please feel free to share our content. We would greatly appreciate it. See you next time.